You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to the show, everyone. Today on Wealth Formula Podcast, of course, is Wednesday. It's the day that we go into detail with Zulfi Ali from Valerity Group on the week's news, basically, the week's financial news. We're also going to review a little bit thoughts on the podcast for the week. Zulfi, how are you doing?
Great, Buck. How are you doing? Good to be back.
Good. Well, listen, let's start out right away and talk about this podcast. So obviously we had Mark Skousen, who is the producer of FreedomFest. Interesting character. He's kind of, in this whole sort of world, a sort of fringe freedom world. I'm not saying there's anything wrong with it, but it's a little different from mainstream. And I bet you had, I bet you had some differences in terms of his take on the economy and all of that.
Yeah. Well, I mean, first of all, who doesn't like freedom, right? I mean, I think it's a great cause, and happy to support that.
And I bet the event is fun. I mean, it sounds like it's.
I'll bet it's full of some fun characters.
Oh
right?
yeah,
I think
for
you
sure.
could get into some really interesting conversations. You
Yeah.
may not agree with everything, but their perspective on a variety of things would be entertaining to say the least.
Right.
But yeah, no, I think, listen, he made a lot of comments on a lot of topics. Some of them made sense. Some of them were, partially making sense. Others I just thought were kind of a little bit, more off the mark.
Yeah, like for one thing, I'm curious on this whole thing, because I actually drilled down on this a little bit with him. But he said he felt like inflation was like 10%. And I still don't understand, because he did explain like some of the other, that he was essentially talking about a lot of the services and that kind of thing that maybe don't go in the bag for CPI and all that. But what's your take on that? 10%?
Well, a lot of services do go in the bag for CPI. So, I'm not sure where he's coming up with the 10%. Maybe I kind of took it as like he said he kind of feels like it's 10%. Maybe
it does feel like 10%.
Certain things are 10%. I guess you could say that it feels like 10%.
Yeah.
I think the numbers don't necessarily show that. I mean, listen, there's always going to be different impact to different folks depending on the basket of goods and services that they buy on a regular basis, right? So. I don't think it would be unusual to have your CPA say, hey, we're increasing your rates by 10% this year, just cost of business and all that sort. So from that respect, I don't disagree, but I think generally when you're measuring inflation, you got to take a broad base of measurements, because there's going to be lots of different things that impact your life, and I think 10 is really, really hard to reach. I think he mentioned shadow inflation and how that's also a factor and could count for a couple of additional points on top of what inflation is reported. I think there's some merits to that.
What do you
shadow inflation?
Do you want to talk? What is shadow inflation?
It's not that complicated. It's basically think of things that you're paying the same for, but you're not getting as much for the same price. I think the recent famous ones are, Joe Biden down there with a bag of potato chips on TikTok saying something about shrinkflation or something like that.
Yeah.
So that would be shadow inflation, because the bag costs the same, or maybe it's gone up a little bit, but the quantity of chips you're getting inside that bag is reduced, and so there is implicit inflation because of that. You're getting less product at the end of the day. So that's a big piece of it. Or it could just be the quality of the goods or services. So some manufacturer using more plastic parts than metal parts in something, right, to reduce the quality, but they're charging you the same. So again, really, really hard to measure. I'm sure that goes on a regular basis. But 10% is probably a real reach in my opinion anyway.
Now this is a little bit of a charged issue, so I don't want to get any sort of political side of this, but at least from the economic side of the question of global warming, he called it a manufactured crisis. There's plenty of science to suggest there is change in climate. I think, how much of it is caused by human beings, how much of it is natural fluctuations. I think there's, a lot of people get pretty charged up about that, but there are the comments he made with regard to the changes in policy about that. What's your take on that?
Yeah, I mean, with respect to what what he was saying on policy, I don't completely disagree with what he's saying. I don't necessarily think that the government's push on EV production at any cost, and disregarding what consumers might want and what manufacturers can produce today or in the near future. I don't think that necessarily makes sense as well. I do think that as a country, we want to be ahead of the curve on EV production, because you don't want Chinese competitors to eat our lunch on what could be a very important future technology.
Yeah.
But the government's involvement on pushing that for climate reasons, I don't necessarily agree with. I mean, I do think he kind of poo-pooed the whether there is global warming. He felt that temperatures seem about the same as far as he's concerned. He's been around for a long time.
Yeah.
I think that some of that I think there's plenty of data that would show otherwise. But I'm with you. What in terms of what the policy implications should be and that sort of thing, that's very debatable, and I think it's healthy to debate those types of things.
Well, I'll tell you one thing, okay, and again, people get pretty fired up on this one side or another, but one thing's for sure, you and I both grew up in the state of Minnesota, and Minnesota is not the same, man. It used to be so damn cold, and this year they didn't even have a white Christmas. It's insane. Yeah. The Great White North has become.
I remember going trick or treating in the snow.
2 years in a row,
regular basis.
2 years in a row. Yeah. There was a blizzard. I remember. So that never happened. So I don't know, man. I haven't lived as long as him, but at least in Minnesota, that was a big change. But then there's some variations, and just I'm not even talking about the politics of this, but it is weird because the previous year I think was really, really cold, and then this year it's really warm. So there's some sort of strange, funky stuff that didn't used to happen where it was just consistent. I remember as a kid being like, every year, when is it going to get to 20 degrees below zero? And it was like nuts, but.
No, I agree. And I think it's that volatility, right? So even if we don't see just a straight line increasing of heat, it's the volatility.
Yeah.
And again, if you live in Florida near the coast, you're feeling it with insurance rates, right, on your home. And that's because 100%. insurance companies have done their actuarial math and said, hey, this is different. This is a lot different than it was, 10, 20, 30 years ago. And they've had to readjust their models.
Yeah, right? that's actually a good point, too, because I actually interviewed somebody who does liability insurance. Just seems like kind of a boring topic, but it was pretty interesting because she did mention, why property taxes are going up so much. And a lot of it is because of these massive payouts that these companies have had to do. And, you have the 1,000-year storm every, 3 or 4 years. It adds up. But I talked about Trump versus Biden in terms of policy. The one thing I disagreed with him there for sure was that Ronald Reagan would be elected today. I don't believe Ronald Reagan. I am a big Ronald Reagan's one of my favorite presidents of all time, if not the most. But he was a free trade sort of. He was a very different character. I don't think he would be elected. But
I agree with you. I actually agreed with your point that the Republican Party's changed quite a bit. I think the focus of their policies are very much hard to identify if you were kind of a Republican 5, 10, 20 years ago, right? It doesn't. Well, it's a very different agenda.
And one of the things that, as a generally a conservative guy myself, that I have a hard time with is that there really is no party right now that is about fiscal responsibility. There really is none. I mean, whether that's in the form of, because both parties want to spend a ton. There's no doubt about it, right? The big difference is that one party wants to tax and one party doesn't want to tax, and that's effectively the big difference. So I don't know. I mean, I think that's pretty much it. Yep. I mean, from the fiscal standpoint, because nobody nobody, like, back in the day, even, and I say back in the day, I mean, even like 10, 15 years ago, I remember, guys like Boehner and all those guys really hitting hard a lot of these issues that we know that need reform, like Social Security and all that. But you don't hear any of that anymore because it's politically unpopular. You can't take away something from somebody. And then, let's move on to the economy, the markets. What's going on here? What's going on since last week?
Well, there was some excitement that took place since we last spoke. I think it's actually on the day that you released this discussion last week. May CPI was released, and it came in slightly better than expectations.
Better? What do you mean better?
Better meaning less inflation.
Okay. Okay.
So it showed on an annual basis, it still showed, 3.3% price increase from the previous year.
What was the expectation? Do you know?
It was just slightly more. It was 3.4. So it's not a big move, but directionally it was in the right direction, right?
Yeah.
And then more importantly, on a month-over-month basis, it was flat. And that's actually the first time we've seen no increase in CPI month over month since going back to May of 2020. So you're talking about almost a year before the whole Fed hiking cycle started. That's the last time we were at a point where month over month there was no increase in CPI. So that actually came out to be quite a signal that the markets liked a lot. On the same day that the May CPI was released, FOMC meeting had concluded, and Fed chairman came out and said that they weren't changing rates, but he also said that there's likely only one rate hike expected now.
Rate cut
for 2024.
Yeah, I was going to say rate hike.
Sorry, my bad there. I'm glad you corrected me. Previously, they had anticipated two rate cuts, but now they're saying that overall they expect only one in 2024. So what's interesting is that could have been taken quite negatively by the market, because the market's been expecting two to three cuts in 2024, but that didn't seem to impact the trading of the equity markets or even the bond markets, and they reacted much more positively to the CPI, the CPI print that came out. So really, if look at what has happened in the markets, public markets, since we last spoke, stock markets have continued to rally, hitting all-time new highs. The Treasury, the 10-year Treasury has come back down by 20 basis points to 4.2%. So that's pretty significant. I just checked, what does a 30-year fixed mortgage rate look like as of today, and it's really right at about 7%. And it was almost 7.4 a couple of weeks ago. So that's come off quite a bit. So we're seeing some good reaction from the markets on that news. Gold, we always talk about gold and Bitcoin as well, but just to round it out, gold is pretty flat from last week. Bitcoin though is off by about 4%. There seems to be some volatility there. I don't see any particular reason for it, but there never
really is any real reason for it. But I heard, so on that front, I had heard that there was a lot of sell-off from institutional buyers. So maybe they're just taking profits, that could
it could be. It
could be part of it. But yeah, the question of, there's always news every time there's this pullback, if it's the end of the bull market or whatever. I don't really see any reason that would be the case right this moment. But okay, so I think that's probably, that's not bad news. I mean, except for crypto, it's a little bad news. I would just say, in terms of like my own thoughts on that FOMC thing, I think that it's actually kind of not a big surprise at all to me that it's one cut. And I'm guessing that's probably what everybody had, that's what people had probably factored in, right? 1 or 0 cuts, because, you know, the thing is, the election is not too far away. I mean, they don't really have time for 2 cuts, in my opinion.
Yeah.
So I'm actually pleased to see we even got one, you know, a forecast of 1 cut. So
I'm with you. I mean, I personally didn't think there'd be much more than 1 cut for this year. So to me, it's very consistent. And, you know, again, it's, I think, a signal from the Fed that they are looking to cut. It's just a matter of time, right? So at the end of the day, their stance is for lower rates going forward. So I think that tends to be favorable for, you know, for the markets, for investors, all of that.
You know, and one other thing to think about, I think that because real estate has been a tricky place to be in with the rates and inflation and rates following and all that kind of thing, you know, the sort of the ideal time from a macroeconomic standpoint, like in terms of interest rates to buy, is when interest rates are highest. And the reason being that interest rates, as they go down, so do cap rates. And so, just as an aside, you know, buying it when rates are higher is probably a heck of a lot safer than buying it when rates are really, really low. For the reason that if rates, again, over the course of the next couple of years, 2-3 years, rates go down, you're going to see a natural increase in value simply from cap rates that go down with it. So that is something to think about. And I know it's, you know, I know as rates go up, a lot of people are a little gun shy, but, you know, keep that in mind for sure.
Yeah. Yeah. And I think the other thing to keep in mind as well, Buck, is that, you know, although rates will go down and mortgage rates will go down, I really don't think that you're going to ever, well, at least in the near term to midterm, you're going to see rates going down to, you know, 3%,
Sure.
4% on one of these. So I think affordability in terms of purchasing a home, a single family home, is still going to be pretty tough for folks. And I think the demand for rental units is going to remain really robust. And if anything, what we're seeing now from some recent data that came out is that, you know, whereas some markets had been kind of down for the last year in terms of rent pricing, it looks like things have stabilized. There's certain markets, even in the Midwest and the East Coast, that are starting to uptick again. So we're seeing that kind of, you know, phase where they came down, flattened out, and now they're feeling stable and maybe even starting to rise again. So I think that'll also be a nice backdrop for, you know, for that kind of investment class.
Right. All right, so let's talk. When we go to this segment that we've got every week, where we're starting to talk about sort of we're talking about products, financial products that, you know, just to give people some background on things that maybe they may have some interest in, or if they may just hear about, and so you can sort of explain what they are. And this week we're going to talk about structured notes. So what are structured notes?
Yeah, so structured notes. I mean, the topic came up, Buck, because there was a couple of investors that I've recently spoke to, and they had actually bought some structured notes, and they really didn't understand what they bought at the end of the day, other than they assumed that they had some sort of guaranteed coupon and you know, guarantee of principal and that sort of thing. And so, you know, that is generally not the case. So structured notes they're actually pretty complex financial instruments. And so it's not surprising that, you know, unless you really are, you know, sophisticated and can dig into the structure, it is going to be hard for you to understand. But typically it's a bond, oftentimes a zero coupon bond, linked with a derivative component, and that derivative component.
Okay. Well, hold on, slow down, Tiger.
Yeah.
So zero coupon bond, define that. What does that mean?
Zero coupon means that it has no cash interest that it's going to pay. So it is typically issued at a discount, at a deep discount, and that interest that you would have made is effectively accreted onto the price of the bond. So let's say you buy a bond at 80, the issuer says, well, I'm going to pay you back 100 upon the maturity of this bond, right? So that's what that means. You don't get any coupon distributions along the way.
Okay. Yeah. So they're basically saying we're not paying anything along the way. We're just, whenever this thing comes due, we're going to pay you not 80, but we're going to pay you 100.
Yeah. Effectively, you're buying $100, 100 principal, but you're buying it at a discount, and then you're going to get it at par at the end. So you're kind of making that return from that component.
Okay.
And then what they do is they then attach a derivative component to that bond, right? So now the derivative is really a financial instrument that's going to perform in a certain way based on an underlier. So that underlier, for example, might be the S&P 500. So it's the derivative might be such that if the S&P rises by 5% a year, that derivative is going to pay out X percent per year.
So a derivative is essentially something that is not directly correlated, but has some correlation. So, for example, options would be a derivative, right?
Their options are derivatives. They are an instrument that are designed around another securities product. So their performance is linked to the performance of that product.
So in the case of a structured bond, how would a derivative work? Like, what kind of derivative?
So so now, depending on what the structured note is meant to do, so you could have, structured notes that are trying to achieve yield, they're trying to achieve growth, they might be trying to just have principal protection. So based on that, this underlier can be very different. It can be like I said, it could be a stock index, it could be a commodity, it could be some other type of security that is readily trading and that sort of thing. And so really what that derivative piece, that's trying to design the outcome. So it might be a design to say that that this is going to generate 6% per year or whatever, or it might be that, hey, we're trying to design this so that if the S&P goes up by 20%, you're going to make 10%, but we're going to cap your losses, and if it goes down by more than 5%, you won't suffer any more than 5%. So it might have some sort of derivatives around it to kind of give you a bandwidth and that sort of thing.
Okay.
There's a lot of permutations. There's a lot of complexity. So I don't want to focus on that. What I do want to make sure that investors understand about these, they're typically unsecured debt obligations of the issuer. So a lot of times it's an investment bank that is issuing this. So you might buy it from a broker, you might buy it from an investment bank directly, you might find it offered in some other way. And you've bought this. Really, it might be an issuer. Let's say it's J.P. Morgan, right? At the end of the day, the credit that you are exposed to is the underlying issuer, and so you need to know that that's your safety of your investment is as safe as whatever that issuer is. These are not guaranteed. You're not going to get a guaranteed return. You can't even lose principal on most of these. And so that's the piece that I want to make sure people understand, because a lot of folks have come in to say, well, this is a structured note, I will get that 7% no matter what. And that is not the case. You may or may not receive that 7% at the end of the day. So
are these like publicly traded type products, or where are people finding these things?
They are marketed by a lot of times by banks. So you might find them at your whatever bank you're doing business with. They might have a securities arm that sells you this. Hopefully they give you all the disclosure that you want. They're illiquid. They're designed to be held to maturity. like I said, they're not going to be any government guarantees on these things, and you're gonna have to take the risk that the issuer risk is.
And then at that point, it's sort of like, I mean, it depends on who the guarantor is, right? I mean, if it's J.P. Morgan Chase, then it's you're probably in pretty good hands. But if you're Joe Schmo and company or whatever, then well, think of some regional bank that has a lot of exposure to commercial real estate. I don't think I'd be buying their structured notes, right? Because they might be at risk. So really, that's it. I mean, I think if I don't think we would have time to go into like each type of structured note and all the different permutations and all that kind of stuff. But I think the important thing for people to realize when this is being offered to them is that you really, really need to understand that these are complex instruments, and you need to understand how they're going to behave in each permutation, each type of scenario that could happen. In what context have you been seeing them? Have you been like reviewing people's portfolios and these come up?
That's right.
Yeah,
that's exactly what has happened. I've reviewed portfolios of investors as we're onboarding them onto Valerity Wealth. And we go through each of their existing investments to figure out what do they own, what are they trying to achieve, make sure that that they fits in their objectives going forward. And sometimes we find that they own things that they really don't know the real risks behind them, or the why they may or may not fit in their portfolio.
Got it. Well, that's probably a good time to just remind everybody what you guys do over at Valerity Wealth. It's basically, I think it's probably the closest thing that high-paid professionals, high wage earners who aren't ultra-high net worth, who have their own family office, can do, right? It's basically a family office type situation. Do you want to talk a little bit more how you facilitate that?
That's exactly right. So, we know that, most professionals do not have time to spend that is needed to really be thoughtful about their financial situation, about planning, how, they can meet their objectives, financial objectives. How can they, be most tax efficient? How can they protect their assets? All these are obviously very interrelated and should be, thought of holistically. And that's what we do with our clients is work on all of these things together with them.
Fantastic. And again, that's ValerityWealth.com, VELERITY wealth.com. Thanks again, Zulfi. We'll see you next week.
Great. See you next week, Mark.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.